Hello and welcome back to the Financial Freedom Show. When it comes to investing in exchange-traded funds, or ETFs, there's two popular options that frequently emerge: the Schwab US Dividend Equity ETF, or SCHD, and the Vanguard Growth ETF, or VUG. These funds cater to distinct investor objectives, with SCHD focusing on dividend income and stability, while VUG emphasizes growth potential. In this video, we're going to explore the key differences between these two ETFs, their strategies, and how they may fit into your various investment portfolios. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the future videos that are posted on the Financial Freedom Show. Feel free to comment down below if you're adding either SCHD or VUG to your portfolio. If you'd like to have your name featured at the end of every single video we publish, as well as get access to our private Discord server and early access to videos a day before we publish them, be sure to check out the membership in the description. And without further ado, let's get into today's video. So what is SCHD? SCHD is designed for investors seeking dividend income combined with long-term capital appreciation. The fund tracks the Dow Jones US Dividend 100 Index, which consists of high-quality US companies with a strong track record of paying dividends. SCHD's strategy emphasizes companies with consistent dividend payouts, financial strength, and relatively low volatility. Here's some key features of SCHD. The first is a focus on quality dividends. SCHD prioritizes companies with a history of reliable and growing dividend payments. It has good sector composition. The fund leans heavily towards sectors like financials, consumer staples, and industrials, which are traditionally known for stable cash flows and dividend payouts. It has a low expense ratio, with an expense ratio of just 0.06%. SCHD offers a cost-effective way to access a portfolio of dividend-paying stocks. It also has yield and stability. SCHD provides a dividend yield that is higher than broader market ETFs, making it appealing for income-focused investors, particularly retirees. VUG, on the other hand, targets investors who are looking for high growth by tracking the CRSP US Large Cap Growth Index. This ETF invests in companies that exhibit strong revenue and earnings growth, focusing on innovation and market leadership. Here's some key features of VUG. The first is an emphasis on growth. VUG's portfolio is dominated by tech-driven and growth-oriented sectors like technology, consumer discretionary, and communication services. It has good sector concentration. Technology companies such as Apple, Microsoft, and Amazon account for a significant portion of the fund, reflecting its growth-centric approach. It has a low expense ratio. VUG also boasts a low expense ratio of 0.04%, providing cost-effective access to high-growth companies. And lastly, it has good capital appreciation. VUG's primary focus on long-term capital gains rather than income generation makes it an ideal choice for younger investors or those who have a longer time horizon. Historically, SCHD and VUG have delivered strong performance, but their returns are driven by different market conditions. With SCHD, this ETF tends to outperform during market downturns or periods of economic uncertainty due to its focus on stable dividend-paying companies. And with VUG, this ETF thrives in bull markets, especially when technology and growth stocks lead the way. For example, during 2020 and 2021, VUG significantly outpaced SCHD due to its rapid growth of technology stocks. Conversely, in a more volatile or flat market like 2023, SCHD showed resilience thanks to its dividend income and lower volatility. SCHD, with its focus on established dividend payers, it's generally less volatile than VUG. It's well suited for risk-averse investors seeking income and stability. With VUG, the growth orientation of VUG inherently involves higher volatility. Its reliance on technology and high growth sectors can lead to significant swings, both upward and downward, in the long run. SCHD is best known for income-focused investors and retirees or those nearing retirement. It's suitable for conservative portfolios prioritizing stability and cash flow, and it appeals to investors looking for lower volatility and consistent returns. VUG is ideal for growth-oriented investors with a longer time horizon on their investments. It's also suitable for younger investors or those willing to accept higher risk for potential higher rewards. And lastly, it appeals to those who believe in the continued dominance of technology and innovation in the coming years. Both SCHD and VUG can play complementary roles in a diversified portfolio. SCHD can serve as the income and stability and the anchor for income generation and risk reduction, while VUG can add exposure to growth and high growth sectors, balancing the portfolio's risk-reward profile. A balanced approach could involve allocating a portion of the portfolio to both ETFs, depending on the individual's financial goals, risk tolerance, and time horizon. For example, a 60-40 split between VUG and SCHD might suit an investor seeking growth while maintaining some income and stability. When it comes to building a robust retirement portfolio, younger investors often find themselves at a crossroads between prioritizing growth or income. While there's no universally right answer for younger individuals with a longer time horizon, prioritizing growth-focused strategies can be a more effective path to maximizing their retirement savings. One such approach is choosing growth-oriented investments like those exemplified by funds that emphasize high growth potential over income-generating assets. This strategy can be particularly advantageous for younger individuals who have the benefit of time on their side and the ability to weather market volatility. The primary advantage of focusing on growth during the early stages of an investment journey is the power of compounding. Growth-oriented investments typically target companies with a higher potential for revenue and earnings expansion. Over time, the returns generated by these companies can compound significantly, leading to exponential wealth accumulation. For younger investors whose retirement goals may be decades away, this compounding effect can have a profound impact on the value of their portfolio. Growth investments also allow younger individuals to take full advantage of their risk tolerance. Higher growth assets often come with higher levels of volatility compared to income-focused investments, but younger investors are better positioned to ride out market fluctuations. With a longer timeline, they can afford to endure short-term losses for the potential for higher long-term returns. This resilience can be a key factor in achieving a financially secure retirement. Growth-oriented strategies typically prioritize capital appreciation over immediate income, which can be particularly beneficial for younger investors. Instead of receiving dividends, investors in growth assets often see their profits reinvested back into the underlying companies. This reinvestment fuels innovation, expansion, and higher earnings, which in turn can drive stock prices higher. For individuals who are still in the accumulation phase of their financial journey, this reinvestment aligns perfectly with their long-term goals. On the other hand, income-focused investments, while offering stability and regular payouts, may not provide the same level of appreciation over time. Younger investors typically do not require the steady cash flow provided by dividends, as it's their primary goal to grow their wealth rather than generate income. By prioritizing growth now, they can shift their portfolio to more income-focused strategies later in life when they are closer to retirement and their financial needs change. Another significant advantage of focusing on growth is the flexibility it provides in financial planning. A portfolio centered on growth is more likely to outpace inflation and build a substantial nest egg, giving investors more options as they approach retirement. Whether they choose to transition to income-generating investments, pursue part-time work, or enjoy early retirement, the large financial cushion provided by growth investments can make these decisions easier and less stressful. Additionally, growth-oriented portfolios allow younger investors to take a more hands-off approach to their finances. Without the need to manage or rely on regular income payouts, they can focus on maximizing contributions to their retirement accounts and benefit from tax-advantaged growth in accounts like 401ks and IRAs. This hands-off strategy simplifies the investment process and ensures that their financial goals remain aligned with their long-term time horizon. While growth-oriented investments can be volatile in the short term, younger investors have the ability to take a long-term perspective, smoothing out market fluctuations. Over the decades, the stock market has historically trended upwards, rewarding those who remain patient and committed to their growth strategy. As investors age and their risk tolerance decreases, they can gradually reallocate their portfolio towards more conservative income-focused assets. This phased approach allows them to maximize growth early on while reducing their risk as retirement nears. For younger individuals building towards retirement, prioritizing growth-oriented investments like VUG can offer significant advantages. The power of compounding, the ability to weather market volatility, and the focus on reinvestment rather than immediate income all align with the financial goals of someone who is decades away from retirement. They have decades to save and invest. By taking a growth-first approach in the early stages of their financial journey, younger investors can lay a strong foundation for a secure and flexible retirement, ensuring that they make the most of their most valuable asset, time. VUG and SCHD represent two distinct paths to wealth building, each catering to specific investor needs. SCHD offers stability, income, and a focus on quality dividends, while VUG provides exposure to high growth companies and the potential for significant capital appreciation. Understanding the key differences is key to making informed decisions about your investment. Ultimately, the choice between SCHD and VUG depends on your financial objectives and risk tolerance. For those who value steady income and lower volatility, SCHD is a compelling option. Meanwhile, for investors with a higher risk appetite and a long-term growth outlook, VUG offers an exciting opportunity. Combining the strengths of both ETFs can help build a well-rounded portfolio capable of weathering various market conditions. Personally, in my portfolio, I am building a full position in VUG since I'm several years from retirement. I hope you enjoyed today's video. If you did, be sure to hit the like button and subscribe to the Financial Freedom Show to stay up to date with the latest videos that we post. We post every other day. And comment down below if you're buying SCHD or VUG in your portfolio and how many shares you own. Love to hear from you. If you'd like your name to be featured at the end of every single video we publish, be sure to check out the membership in the description. And thanks for watching. I'll see you in the next episode.